Hello, this is Ilan Awerbuch, and this is Mortgage Watch for Monday, November 23rd. We've talked in the past about option arms and the danger that they pose to the housing market and to the general economic recovery. Some people have called them a ticking time bomb, and there's certainly a growing problem that threatens to be as bad as the subprime debacle that kind of started all this mess, but was really just a part of what was going on. Current option arm problems leave homeowners very few choices, and that's kind of contrary to what option arms were supposed to be. But the way it's all worked out is not the way anyone had planned, if they had planned for this at all. Once upon a time, option arms were offered only to homeowners of a certain net worth who had a very, very low loan to value. And basically, they allow the borrower to make several different choices every month in the payment. That's why they're called option arms. They also are marketed as pick-a-pay, negative AM products, which is what they are, option arms, and things of that sort. The borrower can make a minimum payment, but the minimum payment is usually not enough to cover the actual interest that's due. Because of that, the interest that's being deferred or not paid is added on to the loan principal. So you can often have, and we have had for everyone's case, loans that have grown over the past several years. Now again, once upon a time, they were marketed to people who can handle it. Sophisticated borrowers, business people, people who were making choices about where to make their payments, but they always knew or where to place their money, but they always knew that they could always catch up with any amount that they had gone negative on, the amount that got put back on their loan, or manage their money as the way they saw fit. But in the last 5 years, and for a real heyday of 05, 06, 07, option arms were marketed to everybody. You might have gotten continual mailers in your home. I know a lot of people did, and we certainly did. And the option arms were marketed as, this is great, this payment is so low. I even had clients of mine call me and friends and say, look, I'm getting a 1% interest rate offered to me. But if it's too good to be true, it often is. And in this case, they were too good to be true. The initial payment or the payment that you can make that's minimum does not cover the interest that's due. Never mind paying principal, because I'm okay not paying principal, but you have to pay the interest that's due, otherwise your loan is growing. Now we have many, many people whose loans have grown substantially, some as much as 10 or 15%. This is an important threshold because all option arms or negative amortization arms carry information in their loan note that says that if the loan becomes 110 or 115% of the original balance, the lender will then reset the loan and the payment. So people got into these things to have a low payment, found themselves sometimes in as short as 21 months having their loan reset. In many cases, because we've had very, very low interest rates, these loans have not reset. But what's coming down the road is an amazing wave of resets. That is, these option arms where people have been making payments at 1, 2, or 3% are now going to end up at 5, 6, and 7%, and in most cases be amortized. That is, having each month's payment, the principal part of it as well. So people could see their loans potentially double, certainly increase by 50%. There are millions of option arms out there. And the other scary information is that option arms are performing at a very, very low state. 33% or so, depending on whose numbers you look at, are actually not performing and are delinquent in some form or another. So we have a very, very serious situation. So now the solutions are going to come. We're going to see what the government's going to do. If they're going to freeze by law option arm borrowers' payments, everyone else is going to ask that their payments either be frozen or lowered to the same place. Otherwise, we're unfortunately going to have a very, very large debacle on our hands that was marketed as a panacea and unfortunately turned out to be anything but that. A lot of people are in way upside down, and they owe, because of the growth of their loan balance, they owe a lot more than their homes are worth. So how this is going to get resolved, we'll see. But the next year or 18 months is going to be very, very interesting. We'll see what the government comes up with. One thing that this is going to lead to also is a potential double dip, meaning another drop in the housing market. Because if a lot of these borrowers can't pay, and aren't paying and end up going into foreclosure, there's going to be even more homes on the market. Next week, I'm going to talk a little bit more about the shadow inventory and real estate owned that banks have and the effect that it will have on the housing market. But in the meantime, this week, it's about family, friends, loved ones, and still being grateful for all the good benefits and blessings that we have. So I want to wish you all a very, very happy Thanksgiving. I hope that you have the opportunity to share it with family, friends, loved ones, or in any case, have reasons to give thanks. And most of us have things to be thankful for. I hope we'll take advantage of that in this season. Have a wonderful week, and I look forward to being in touch with you next week. This is Ilan Awerbuch with Unitrust in San Diego.